Welcome back to Investing Talk Podcast. Today we are focusing on one of the foundational players in the automation space, the software company UiPath. We're taking the stack of sources you provided, the financial filings, analyst reports, the charts, and our mission really is to answer that core question. Is UiPath a good time to buy now?
Right.
This is a company in, well, a fascinating spot. Rapid growth, sure, but also facing some pretty intense competitive pressure. Before we jump into all that, please remember to subscribe, like this discussion, and leave a comment below. Your engagement really does drive the show.
It absolutely does.
And crucially, if there's a specific company you want us to look into next, please drop that request in the comments too.
Yeah, definitely let us know. So we've put together a pretty comprehensive package for you here. It gives us a full 360-degree view.
Okay.
We'll be reviewing everything from their detailed FY 2025 10K filing.
Filed back in March.
That's the one. Right through to the actually quite positive surprises in their recent Q2 results. So yeah, we're going to cover the fundamentals, the financials, the competition, which is heating up, and those short-term catalysts that could really move the needle.
Okay, let's unpack this. And we should start where every good investment decision really begins. The core foundation, financial health growth trajectory.
Makes sense.
So looking at the financials for fiscal year 2025, filed back in March, the top-line performance, it looks genuinely strong.
Absolutely. I mean, that sustained growth metric is pretty impressive. For the fiscal year, total revenue came in at $13,307 million.
Okay.
That's a solid, approximate 19% year-over-year increase compared to the $1,097 million they did in FY 2024.
19%, yeah.
Yeah. And in the enterprise software world, keeping that mid to high teens growth rate going, especially at this kind of scale, it's critical proof that demand for their automation tools is, well, still accelerating.
But this is where the conversation shifts a bit, right? From just growth to maybe strategic efficiency. They still reported a GAAP net loss.
They did, $120 million.
Which, okay, it was an improvement from the prior year's $193 million loss.
True.
But for an investor just focusing only on that GAAP loss, that can be a bit misleading, can't it?
Exactly. The GAAP net loss, generally accepted accounting principles, it's important, for regulatory stuff, but in the SaaS sector, the real aha moment often lies in the non-GAAP figures.
Right.
And this past year, for the first time ever, UiPath actually achieved positive non-GAAP operating income. Hit $60 million.
Okay, so for the listener who might not track this difference every day, what's the really critical distinction there? What's the biggest thing they're backing out to get that positive $60 million number?
Well, the biggest exclusion is usually stock-based compensation, or SBC.
Ah.
Plus, certain amortization and maybe some one-time expenses. Stock-based comp is a non-cash expense, and it's typically high in these fast-growing tech companies trying to attract talent.
Right, makes sense.
So when the market sees positive operating income after accounting for the main operating costs, it suggests the core business model is finally getting some structural operating leverage.
So it's starting to work, fundamentally.
Exactly. They're moving towards a point where they could potentially flip to GAAP profitability just by, say, stabilizing their SBC or dialing back some other investments. That $60 million positive figure proves the underlying model can be profitable.
That potential for profitability, though, it's balanced by their spending habits, right? Analysts expect sustained mid to high teens revenue growth for FY 2026.
It's good.
But the consensus also notes that margin expansion is likely to be, well, limited. This is the classic tension, isn't it?
It absolutely is. The growth versus profitability dilemma. And it's magnified here by the competitive landscape.
How so?
Well, margin expansion is limited because they're still investing heavily in R&D. They need to integrate things like generative AI. And they're pushing really aggressively into international expansion to grab new markets. They basically have to spend money to keep their tech lead and fight off the giants we'll talk about.
Okay, before we get to the competition, let's talk about their war chest. The balance sheet looks like it offers some serious reassurance, especially now with higher interest rates.
Oh, it's the definition of financial stability, really. They ended FY 2025 with $1,567 million in cash and cash equivalents.
Wow, over $1.5 billion.
Yeah. And maybe the most critical number for solvency risk, 0 long-term debt.
0, okay.
Which means their liquidity risk is, virtually nil. They don't have to worry about debt covenants or refinancing in some volatile market.
And actually, their operational efficiency, it generated cash too, right? I think it was $102 million. in free cash flow, FCF, for the year.
That's right, $102 million FCF.
So that huge cash position, combined with positive free cash flow, that gives them tremendous strategic flexibility, doesn't it?
It offers immense power. They're generating cash, not burning it, and they have $1.5 billion sitting in the bank. Yeah. That cash is their ultimate buffer against, say, competitive pricing wars. And it's what lets them keep pouring money into R&D without immediately hurting their solvency.
Okay, moving beyond the financials then, let's look at that crucial element of execution risk, where they actually sit in the industry. They're seen as the global leader in robotic process automation, RPA.
Definitely a leader.
But that field is getting pretty crowded.
Well, maybe less crowded and more dominated by behemoths now. They still face the traditional rivals like Automation, Anywhere, Blue Prism.
Sure.
But the real challenge, I think, comes from the hyperscalers, Microsoft with Power Automate,
Big one.
and maybe to a lesser extent, Salesforce. I mean, these are competitors with basically infinite balance sheets and the power to bundle competing products into existing enterprise contracts.
So how does UiPath defend its turf then? What are the specific competitive advantages the sources point to as their sort of shield? Why aren't clients just, jumping ship to the free or bundled Microsoft solution?
Well, the sources usually highlight three core strengths. First, they built this massive platform ecosystem, really engaged developer community around it, which breeds a lot of custom solutions.
Okay.
Second, they really have a leadership position in complex enterprise deployments. We're talking highly customized, really intricate workflow automation. They're specialists where maybe a generic tool just won't cut it.
Especially in certain regions.
Yeah, especially strong across North America and EMEA, according to the report.
Okay, those first two make sense. But the third point, high switching costs. That always sounds good in theory, but I have to challenge that a bit.
Go ahead.
If Microsoft starts aggressively bundling Power Automate into standard enterprise agreements for, virtually free,
Yeah.
how high are those switching costs, really, for a CFO who's facing pressure for immediate cost cuts?
Yeah, that's the core tension, isn't it? The
Mhm.
sources suggest the switching costs are high because the integration isn't just, cosmetic. Their platform often sits at the absolute core of a company's mission-critical operations.
So ripping it out is a big deal.
Exactly. Moving from UiPath means not just reinstalling software, but rebuilding custom workflows, retraining staff. That whole disruption is expensive.
Oh.
However, you're right to highlight the risk. The threat isn't necessarily replacement today, but it's definitely pricing pressure tomorrow, and just the speed at which the hyperscalers can replicate or maybe even acquire niche functionalities.
Yeah, that brings us right back to the risk factors then. Competition intensifying, sector consolidation speeding up, continuous pricing pressure. If the giants do succeed in convincing legacy customers to transition to these broader, maybe AI-infused automation platforms quickly, UiPath faces a margin squeeze, right? Regardless of how good their tech actually is.
That is the precise execution risk. If they can't quickly monetize their R&D investments in things like generative AI, which we know are limiting current margins.
The spending we talked about.
Exactly. If they can't do that before their competitors catch up or leapfrog them, then that path to sustained shop profitability becomes much, much steeper.
So you have to keep saying it.
Yeah, we have to keep reiterating that while they are cash-rich, that sustained gap profitability remains the company's single biggest stock-specific question mark.
Okay. Let's pivot now to the current vitals, the technicals and the sentiment out there. As of September 21, the price snapshot puts the stock at $11.87.
Right.
And over the last month, it seems like it's been trading in a pretty tightly defined range, roughly between $11 and $12.30.
Yeah, and when you're analyzing the charts, those boundaries are really everything right now.
Yeah.
Technical support is clearly visible down there in the $11 to $11.20 range.
Okay, a floor.
Acts as a pretty robust floor, yeah. It's been protecting the recent lows from market stress. Conversely, resistance is just as clearly defined between $12.30 and $12.50.
So limited upside for now.
Pretty much. Until they can decisively break above $12.50, any immediate upside seems capped.
And how do the technical indicators summarize the current mood? You mentioned the moving averages, RSI, MCD. For our listener, what does that MAMCD bullish crossover actually signify about momentum?
Well, it signals some stabilization and maybe a potential momentum shift brewing. Look, the stock is currently below the longer-term 200-day simple moving average, the SMA, which is sitting up at $12.38.
Okay, so it's bearish.
It implies some underlying downward pressure, yes. However, the price has stabilized above the shorter-term 50-day SMA, which is at $11.54.
Mm.
The Relative Strength Index, or RSI, that's neutral, 44.94, suggests no immediate overbought or oversold condition.
Okay.
That MACD bullish crossover you mentioned, that's important because it indicates that the short-term trend momentum is starting to move higher than the longer-term momentum.
Oh, okay.
So the summary. Technicals are kind of neutral to maybe mildly bullish.
Yeah.
Suggests this consolidation period might be nearing an end, potentially.
That contrasts interestingly with the overall market mood, though.
Yeah.
Analysts seem to be holding steady, but the broader market is showing definite caution, fear even.
That's right. The consensus analyst rating is currently the average price target is $13.41, which, offers about 13% upside from here.
Okay. Decent potential upside on paper.
On paper, yeah. But if we look at the overall market sentiment, like the Fear and Greed Index, it's reading 39. That indicates generalized fear in the market.
Right.
So the question becomes, is that $13.41 price target just wishful thinking based on fundamentals? Or is the market maybe overreacting to macro fears and kind of neglecting UiPath's specific stability?
Let's focus on the good news then, the things that might overcome that fear. The near-term drivers and maybe the longer-term tailwinds. The sources definitely highlight some genuinely positive results from their most recent quarter, Q2 fiscal 2026.
Oh, they absolutely crushed it in Q2, relatively speaking. Posted 14% year-over-year revenue growth, came in at $362 million.
14%, okay.
But the key metric for any SaaS company really is annual recurring revenue, ARR.
Right.
Their ARR was 11% higher year-over-year, hitting $1.723 billion.
Wow.
That ARR number is the clearest signal you get of future stickiness and financial health.
And management felt good about it.
Yeah, they were confident enough to actually raise their full-year guidance, and they maintained a very strong 108% net retention rate.
Okay, 108% net retention. That means not only are they keeping basically all their existing customers,
Right.
but those customers are, on average, spending 8% more year over year.
Right.
That's a pretty powerful indication of product value, isn't it?
It really is. It shows the platform isn't just sitting idle. Users are finding new ways to integrate it, expand its use.
And they're making strategic moves, too.
They are. Backing this up, they inked a strategic partnership with HCL Tech, aiming to accelerate enterprise adoption in new global markets.
Okay. And they introduced this concept I found kind of fascinating, the Customer Zero Transformation Project with Deloitte. That sounds like brilliant internal marketing almost. Are they basically using their own automation success as a big live case study for new clients?
Precisely. It's textbook walking the talk. They partnered with a massive firm like Deloitte to automate Deloitte's own internal processes using UiPath software. So now, if a potential client asks, yeah, but does this really work at scale? UiPath can just point to Deloitte's huge, complex internal transformation powered by their own stuff.
So it's a strong benchmark.
Yeah, alleviates potential implementation concerns. It's clever.
So when is the critical date we should all be marking on our calendars? The next big potential price mover?
Okay, the most critical near-term event is definitely going to be the Q3 fiscal 2026 earnings announcement, currently scheduled for November 7th, 2025.
November 7th, okay. What are investors looking for?
Investors will be scrutinizing two main things. First, that AR trajectory, we need to see continued health there, obviously.
Right.
And second, the subsequent guidance for Q4 and, crucially, for the entirety of FY 2026. Any significant beat or miss on ARR or future guidance will absolutely determine the stock's short-term direction.
Makes sense. Beyond earnings, are there other, maybe more technical volume drivers coming up?
Yeah, a couple of things to note. We should see the institutional 13F filings around October 9th.
Ah, the big fund holdings.
Exactly. They reveal how major institutional funds have shifted their holdings, which can sometimes signal investor conviction or lack thereof. Also, ETF and index rebalancing is slated for around October 24th.
Right.
Those events can certainly cause volume spikes and some temporary price swings as automated funds adjust their positions. Nothing fundamental, but can move the stock.
Okay. Looking longer term now, what's the biggest potential catalyst that could justify holding this for, say, multiple years?
I think that catalyst really is the successful adoption and integration of generative AI capabilities fully into the platform.
The R&D spend paying off.
Exactly. If that R&D spend pays off and they can leverage AI to create automation tools that are, say, exponentially faster or smarter than what rivals offer, that could drive massive revenue expansion and really reestablish their technological leadership. That's the multi-year tailwind you'd be banking on.
And yeah, we are hearing those speculative rumors too. Things like bolt-on M&A in AI workflow, maybe industry chatter about large government or defense contract wins.
Right, just rumors for now.
While they are just rumors, the fact that they do have that $1.5 billion in cash makes any M&A speculation immediately credible, which is a structural advantage in itself.
Exactly. Their ability to actually execute strategic acquisitions is a key differentiator against smaller, perhaps more cash-strapped competitors.
Okay. So let's bring everything together now. Synthesizing the $60 million non-GAAP income, the massive cash position, but also that relentless competitive pressure.
Yeah.
What's the final investment thesis summary based on these sources? What's the bottom line assessment?
Well, the overall rating, if you synthesize all these sort of nuanced data points, it lands around a 5.5 out of 10.
Okay, middle of the road, leaning slightly positive maybe?
Yeah, I mean, we're definitely in a high-risk, potentially high-reward scenario here. The pros are clear. Strong revenue growth, phenomenal financial health thanks to that huge cash pile, and zero debt.
Can't argue with that.
And their established leadership in a still expanding automation niche.
And the unavoidable cons. The flip side.
The flip side is those compressed margins, primarily due to the ongoing R&D spend, which means sustained GAAP profitability is still unproven.
The big question mark.
The big one. And of course, that intensifying competition from massive, incredibly well-capitalized cloud competitors who can absolutely afford to undercut them on price if they choose to.
Right.
And technically, as we said, we have pretty limited upside right now to that $12.30 resistance, with potentially significant downside risk if macro market caution or fear continues or worsens.
So, based on all that, what does this recommend for the listener's investment horizon? Why couldn't a short-term trader just jump on, say, that Manti-D crossover momentum play?
Well, the sources strongly suggest this stock is probably better suited for a long-term investment, thinking 3 years or more out.
3+ years, why?
Because a short-term trader just faces too much volatility right now, and that limited upside, given the defined resistance levels and the generally cautious market sentiment.
Makes sense.
That long-term horizon is really required because it gives the company sufficient time to hopefully execute on its AI strategy, demonstrate sustained operating leverage, and finally, prove that it can achieve consistent GAAP profitability. That's what's essential for a true valuation re-rating down the road.
Okay, so here's a final provocative thought for you, our listener, to consider. Given the company's undeniably strong financial health, all that cash, zero debt, what might it signal if management, instead of maintaining this heavy focus on R&D investment, which, as we've discussed, compresses current margins, what if they shifted that focus towards, say, strategic M&A, or maybe even a large share buyback program? How would that kind of shift change the outlook for proven, sustained profitability and the ultimate valuation narrative for UiPath?
Yeah, that pivot from just R&D focus to active capital deployment like M&A or buybacks, that would dramatically change how the market calculates their true long-term profitability potential. It's definitely the kind of strategic move that could redefine the company's story.
Something to think about. Thank you for joining us for this analysis of UiPath.
Always a pleasure. Thanks for having me.